Hey everyone, thanks for tuning in to this month's educational video for April. You may have heard the phrase before, diversification is the only free lunch in investing. It's a phrase that was coined by Nobel economist winner Harry Markowitz. And the idea is that you don't necessarily have to sacrifice returns in order to reduce risk. And so in today's video, Kevin and Alex are going to explain what diversification really means in terms of portfolio construction and why it's particularly important to be diversified appropriately, especially in recent months with, some volatility creeping into the market with the war in Iran. Diversification really allows investors to be able to reach their goals more simply because again, you don't necessarily have to reduce your returns in the long run, but in the short run, you may experience less volatility, which helps you ultimately reach your goals by not making the wrong decision at the wrong time. So I'm excited to hand it over to Alex and Kevin, who will explain a little bit more about the topic today. Thanks.
So, whether you're building wealth or you're approaching retirement or you've already started drawing income from your portfolio, diversification is one of the most important tools that we can use to help smooth out the volatility in a portfolio and try to reduce the overall risk. Now, what is diversification? Diversification is the practice of spreading your investments out across multiple different asset classes, sectors, and regions around the world. So many of you will have seen this Morningstar report, which is up on your screen now. And this is a tool that we like to use to analyze the diversification within portfolios. So in section 1 here, you can see that the pie chart shows how your assets are allocated within classes. So you may have cash, equities from various geographies around the world, and fixed income products in there. Now, looking at this next chart, the stock analysis, you can see that your investments are allocated in a number of different sectors, and they're not focused on one specific area or the other. Lastly, looking at this chart, which shows the world map, you can see how your investments are allocated globally around the world. Now, the reason why this matters is simple. It's because investments don't return the same amount or perform the same way at the same time. So what we want to do is we want to try to take the best pieces of everything around the world to try to reduce the overall volatility and the risk that you're seeing within the portfolio.
So why does this portfolio diversification matter so much? Now, first off, it's important to note that being diversified in your portfolio doesn't eliminate risk, but it can help reduce it. And by reducing the risk, we can help smooth out your investment journey, and it also helps smooth out your returns. Now, by doing that, it means that you may not experience the highest highs within your portfolio, but it also means you won't experience the lowest of lows. And it's really that latter part that helps keep investors invested and stay the course with your financial plan. If you take what's going on in the world right now, for an example, when the US first went to war with Iran in March, we saw downward volatility in the investment markets. Now, because people are in diversified portfolios, they don't feel the full weight of that downward pressure. It helps smooth it out. And by doing that, those investors stayed invested. And because they did, once we got into April, and we're now just over 2 weeks in, most of those investors have either fully recovered or have almost fully recovered from the negative month we saw in March.
So what are some common misconceptions that we hear around diversification here? One of the first ones is that, just because you might own, say, 5 different technology funds, that doesn't necessarily mean you're diversified because all of those funds are invested in the same sector and the factors that move those funds up and down remain the same for all 5 funds. Another misconception that we sometimes hear is that just because a client may only have one mutual fund or ETF in their portfolio, that they are not diversified. Now, that is not the case either, because within that mutual fund, it's very likely that there's between 30 or 100 or even more than 100 different stocks, bonds, GICs, and cash allocations within that portfolio. So just because you might have a one line item portfolio does not mean that you're not diversified well around the world, within sectors, and within different asset classes.
So to kind of wrap things up, diversification is really the most important tool we have when building a portfolio. And regardless of where you are in your life, the diversification really does matter. If you're younger and building wealth and you don't need this money for decades, you might be all in growth equities and stocks. And that's fine, but you're diversified not just in one region. So you want to be diversified in the US, Canada, international. You're not just in one sector, you'll be diversified across sectors. If you're a retiree and you're drawing an income from your portfolios, you're not going to be all in stocks. You're going to have a sleeve of fixed income and some cash. And that part is really important during times like this because that's where we're taking your income from, that fixed income and that cash. So the growth part of that portfolio, the part that's in equities, can ride out market volatility like we're experiencing because we're not taking any money out of that section. So regardless of where you are, diversification is a huge tool. Like I said, it doesn't eliminate risk, it doesn't guarantee returns, but it does help reduce risk and smooth out your investment journey as you move from point A to point B and reaching your financial goals. But if you have any questions about your portfolio or just want to review it with Harry, David, Alex, or myself, give us a call. We'd be happy to chat.